bear with me as we have some stragglers. Okay. All right. Well, so we're going to get started here, and I just want to go over a couple of housekeeping items. And the first one is I'd like to leave the end of our webinar for the Q&A session. So I understand that some people can't stay the whole time and they do have questions. So if you could utilize the chat feature, I think that would be most helpful, just so we're not, interrupting myself or Skyler when we're talking. And the second one is I just want to let everyone know that neither myself nor Skyler, we are not legal advisors. So we are here giving you information, but we're not talking about specific scenarios. It's more of an educational format. And so for those of you that don't know me, my name is Megan DeStito, and I'm the owner of Southern California Exchange Services. And so I'm a 1031 exchange qualified intermediary, and my office is located in Camarillo, California. But because we're talking about a federal statute, no matter where your relinquished property or replacement property resides, as long as it's within the United States, we can document your 1031 exchange for you. So for those of you that haven't heard me speak, I like to just be very basic about, especially for this webinar, I want to just go over the very basics of the 1031 exchange process. And that way, by the time that we get to Skyler, then everybody will have a really good understanding of where his conversation fits within the 1031 exchange parameters. So without, sorry, I don't know why I can't change it. There we go. So for those of you that don't know, a 1031 exchange allows real estate investors to defer paying any capital gains tax when they're selling an investment property, as long as they reinvest those monies into another investment property that is equal or greater in value. And I just want to say this, that 1031 exchanges have been around for over 100 years. And what I find fascinating is that within that time, they haven't really changed drastically. And I mean, I find it fascinating that everybody still has the opportunity to pay $0 in taxes if they do their exchange correctly. Like, that's just kind of amazing that, that aspect hasn't changed. It's been threatened, but it's still around and people are still able to do that. So I just thought I'd add that in there. So when we're talking about 1031 exchanges, you may hear the term like kind or like for like. And I just think that that's probably one of the most misunderstood terms within the 1031 exchange conversation. I feel that many people are under the impression that like for like means I sell a condo, I must buy a condo, or I sell a house, I must buy a house. And that's really not the interpretation that you should have. What the IRS is saying is that it's merely an investment property, a property that's held for not personal use, but business investment purposes. As long as you're exchanging that and replacing it with another one, more than likely it qualifies. Now, the majority of real estate transactions or properties do qualify, but not all of them qualify. So the primary caveat is that you're reporting it as an investment property for tax purposes. You're not reporting it for personal use, and that you have your P&L statements that further show that you're collecting income on it and that you're doing everything on the up and up. So in other words, when you're structuring a 1031 exchange, there's so many different ways that you can put it together. And that's what I find is really an incredible tool. So properties that do qualify are your single family residences. So you have your short-term tenants or your long-term tenants. It doesn't really matter. Again, it's all in how you're reporting the property. You have your multi-unit. So we're talking about a duplex or a triplex. So for those that are kind of doing the house hacking where they're living in one unit and renting out the other, if you decide to sell that property, technically, if we're going to talk about a duplex, if you're renting out one unit and living in the other one, and you decide to sell it, you can technically exchange 50% of that unit. So you can take 50% of those proceeds, but still exchange it into another property 100%. So you can go from 50% to 100% of this. And then you can still use the primary residence portion to use those monies to replace your primary residence. So again, it's another incredible way that you can utilize a 1031 exchange with different types of assets. So you have your vacant land. I don't think I need to explain that. And then we get into commercial real estate and the DSTs, which is what Skyler is going to be presenting. The commercial real estate, I think a lot of the general public and mom and pops maybe don't realize that you can buy pieces of commercial real estate. So you can find affordable pieces that can bring you passive income. And so these are incredible options and opportunities to really start diversifying your real estate portfolio. Then you have your farmland, and then lesser known things such as 30-year leasehold interests. So I've done a couple where it was like a rancher was leasing his land, and as long as that lease is 30 years, that there's value in that, and that actually is exchangeable. And then you have your oil and mineral rights. I just thought I would throw that in there just because it's lesser known, but it is an option, even though it's not tangible real estate. So let's talk about what specifically doesn't qualify. Like I mentioned before, it's your primary residences. That's personal use. It's a completely different section of the tax code. It's section 121. And so those don't qualify for your exchange. But properties held for resale. We're talking about people who flip real estate, who acquire a property, fix it up with the intention to turn it around for a quick profit. So neither you nor the property qualifies in the eyes of the IRS because they view you more as a dealer of a real estate asset versus an investor, a long-term investor. Vacation homes that are primarily used for personal use don't qualify. So if it's just your second home, that does not qualify for exchanges. But if you have like an Airbnb and you're using the property here and there, then it can qualify for an exchange. The general rule of thumb is that you only use that property for personal use for 2 weeks out of the year, or 10% of the allotted time that it's rented. So in this scenario, if you have an Airbnb and you already know it's projected to be renting out for 200 days out of the year, you can safely use that property for 20 days and it wouldn't be raising a flag to the IRS. It would qualify as your investment property. Stocks, bonds, mutual funds, those are not real estate assets and therefore they don't qualify. And then we have your REITs. Even though REITs are a real estate investment trust, it's a real estate asset, the way that it's structured does not qualify for 1031 exchanges. So I want to really define, like I mentioned before, you can't be a dealer, you need to be a long-term investor, but what defines a long-term investor? And unfortunately, within the tax code, it's not exactly specified. It's kind of a gray area, but I think enough legal advisors have come to their own interpretation where you will probably hear one of two things. You'll hear, make sure that you hold on to the property and report it as your investment for at least 1 year before you decide to do an exchange. I think a more conservative approach would be someone would say, hold on to that property and report it for at least 2 tax periods or 2 years before you decide to do an exchange. I think the most important thing to know is that first of all, you should, if you're feeling like you're in this gray area, you're not sure how long, whether or not you qualify, you need to get an opinion from your legal advisor. So talk to an attorney or talk to a tax advisor to say, hey, what do you think? Do you think I can do an exchange with this property? And if they give you your stamp of approval, then you can call me to set up your 1031 exchange. But you want to make sure that this applies to the property that you're relinquishing and then the property that you're replacing. So you want to make sure that when you're doing your 1031 exchange, your replacement property, you need to go in with the intention that you're going to be holding it for long term. And because some people, you can keep exchanging and exchanging and exchanging. So if your intention is to do an exchange, but turn around and quickly sell it, you could be jeopardizing this exchange because you're not holding on to that replacement property long enough to satisfy that one exchange requirement. I just want to define why you have to use somebody like myself. So you have to, and if you're doing a 1031 exchange, you need to hire a qualified intermediary, somebody who's neutral to you, neutral to the transaction, to document your exchange. And I just want to make sure that everybody understands that when you're doing a 1031 exchange, you're actually giving up your right to the property at the moment of close. So you're kind of assigning that right over to me if I'm your qualified intermediary so that I can operate on your behalf. And by doing that, and by giving up access to your own monies means you're not going to be paying tax. So the moment that you start touching that money is when you're paying tax. So that's what I'm doing for you, is I'm making sure that there's verbiage in place that is clear to the closing officer that I'm stepping in on your behalf. And that's how I'm able to access those monies and have them come to me, where I will keep them safe and secure in your own segregated exchange account. And that way I will do the same thing for your purchase or multiple purchases, where I will also fold into those transactions as well and be able to release those monies on your behalf. But that is a requirement. You cannot use somebody who's related to you or somebody who's worked for you or you've worked for them for the last 2 years. So just let's talk about the requirements. Very basic. If you're trying to defer 100% of the capital gains tax, you must follow these guidelines here. You want to make sure, first of all, that you are purchasing a replacement property that is equal or greater in value than what you sold. So I'm going to be looking at, as a qualified intermediary, I'm going to be looking at your closing statement, the final closing statement, and that top line is going to say total consideration. That's the value that you need to replace. Now, you can take into consideration any closing costs and commissions that you paid off that transaction, and that can be deducted from that value. And that's the true value that you need to be replacing in your replacement property. Now, you can spread that into multiple replacement properties that add up to that value. But for simplicity purposes, you want to make sure that if you're selling one property and your intention is to exchange it with one another, that value matches or is greater. Any proceeds that you're netting from that sale transaction that's being held with me all need to be reinvested into that replacement property. And if you're paying off a loan from that sale property, you want to make sure that you are replacing that same amount of debt in the new property. And when you're doing your 1031 exchange, I'm looking at your closing statement, and at the top, it's going to say your settlement date or your disbursement date. That's really the date the deed recorded. And from there, that is when your exchange clock begins. So you have this first 45 days that's called the identification period. And you need to either be in contract on your replacement property. If not, then you need to have a list of properties that shows what your intention is to me and eventually to the IRS of how you plan to reinvest those monies. You have to have that. You have to have done that step in order to move past that for your exchange. If you've done that, then you have an additional 135 days to complete your 1031 exchange, which means that you're purchasing a property from that list or closing on that contract that you entered into. So it's a total of 180 days. And the last requirement, of the main requirements, is that it needs to be the same taxpayer that's selling and buying. So if you're selling as husband and wife, you need to be buying as husband and wife. But I just want to touch on this real quick because there are some people who are within a partnership. So the partnership is really the asset, but the partners of the partnership all kind of want to go their separate ways, which means that they need to dissolve that partnership probably, and each partner needs to take on an undivided interest. So the reason that I'm mentioning that is because if you know that that is kind of like you're selling, we're going to exchange a property, but I want to kind of go separate myself from this other person on the sale, you need to plan for that. So you need to plan for that ahead of time, which means that you probably need to work with an attorney or a legal advisor to help you get out of that partnership, get on to title as an individual so that you can move accordingly and stay that same entity, if that makes sense. Another little caveat that I want to mention is, let's just go back to the husband and wife. So the husband and wife is doing the exchange and then they're purchasing, but they're purchasing into maybe a commercial asset where there's other real estate investors on that, and they want a level of protection. So you can form a single member LLC that in the eyes of the IRS, that is considered the same taxpayer. So you can go from husband and wife over here to this LLC where it's still just the husband and wife, because for tax purposes, it's still them reporting it, even though they have this level of protection. So I really want to go back to the three factors: the value, the debt, and the cash. And so let's just say on that closing statement that I had referenced that the total consideration was $1 million. And the debt that you paid off was a loan of $500,000, which means, for simplicity, that you netted, and I'm holding $500,000 of cash. When we're looking at replacement properties, you, of course, want to buy another property or multiple properties that adds up to $1 million. But I want to talk about that debt portion. So with the debt, you would need to take on another loan of $500,000. But if you didn't want to do that, especially with the interest rates being as high as they are, you can take on a smaller amount of debt, but you have to bring in cash to make up that difference. So in our scenario, if you didn't want to take on that $500,000 loan, you could take on a $300,000 loan at 8%, but it just means that you're bringing in $200,000 of your own money to make up that difference. And you're still having me reinvest the $500,000 of proceeds. In this scenario, what you don't want to do is you don't want to take on too large of a loan, which means that you're pocketing the proceeds that I've been holding for you. In other words, in this scenario, let's just say you decide to take on a $600,000 loan, which means that I'm only reinvesting $400,000 of that cash for you. That means that there's $100,000 left over, which is going to be, for you, pocketed. I'm going to say they call that boot, and that is actually taxable. So even though you're buying equal or greater, you're not fulfilling the cash obligation. So you have cash boot in this scenario. And so the boot portion is taxed first, and anything above and beyond that from the gain would then be deferred. And then with exchange timeline, I want to go back to that as well, because it's very important. I had mentioned that within the first 45 days, it's called the identification period, and you have these requirements that have to be met. But within that 45 days, if you do not follow that requirement, your exchange is over on the 46th day. So I would be returning all of those monies to you on the 46th day, and then you would have full recognition of gain. So that 45-day period is absolutely imperative if you want to move forward in your exchange. And so, of course, you need to make sure that you have that letter to me within that time frame. And then you have that additional 135 days to then complete your 1031 exchange. If your 45th day falls on a weekend, you still have to get a letter into me by midnight on that 45th day. So there is no exception to that particular rule. And the same thing falls with the 180 day. So if you're waiting almost that full 6 months to close on that replacement property, you want to make sure that closing, if that 180th day falls on a weekend, you have to make sure that property closes that Friday before that weekend. If you close on that Monday, you don't have an exchange at that point. It's null and void. So there are no exceptions to that rule, except if there is a natural disaster. And so that's not always guaranteed. I know that practically the whole state of California, fell within this time frame extension due to all the natural disasters. But you still want to make sure that if you think that you or a party to the transaction was affected by a natural disaster, you need to make sure that you're conferring with your legal advisors to make sure that you are getting the extension. You can't just assume that that's automatically applied to you. And then the 45-day identification letter. So if you haven't been in contract on a property, then that means that you're going to be putting together a letter that's going to go in the file with me. And it's kind of audit proofing you, if you will. So the 45-day identification letter is a letter that's addressed to me, your QI, or it can even be your accountant, but it's basically stating out the intentions of how you plan to complete your 1031 exchange. And so it's dated and it's signed and it's listed with the addresses or the property description specific percentages. The more information, the better. So it's absolutely clear and certain what it is that you're investing in. So you have 3 guidelines or 3 rules. You're picking one of the rules. The first one is the most generic, and it's the 3 property rule, where you can identify up to 3 properties where there's no value, no limitation on the value, and the letter can be interchanged. So if you realize that this property is no longer available, you can take it off that list, resubmit a letter to me, interchange it up until the 45th day. If you want to identify more than 3 properties, then you fall either in the 200% rule or the 95% rule. So the 200% rule says that you can identify more than 3 properties as long as the fair market value of those that you're identifying does not exceed 200% of what it is that you sold. So in other words, if you're identifying more than 3 properties, then you're starting to have to crunch numbers. Like, does the math work? Am I abiding by this rule? Am I over 200%? If that's the case, then you maybe fall in the 95% rule. And the 95% rule says that you can identify more than 3 properties as long as you're purchasing at least 95% of what it is that you identify. So those are really the guidelines from an exchange point of view. And I think that this is a really good opportunity for me to start to bring Skyler in, just because this is kind of the area where if people are having a hard time identifying a property and they're kind of stuck, but the clock is ticking, then he has really good investment options that can really work really well for this aspect of the 1031 exchange. So at this point, I'm going to stop sharing my screen and I'll allow Skyler to come on and introduce himself and share his information and his knowledge with you guys.
Thanks, Megan. Appreciate it. Before we get started on my side, pop quiz, everybody. No, I'm just kidding. Thanks again for having me on. I appreciate it. I think, like, from an exchange perspective, it's important to have a really good qualified intermediary. Megan does an incredible job. So I would say if you have clients, if you're a real estate agent, you have clients that do exchanges, or if you are an investor, I would absolutely give her a call because she can totally help you guys out. So let me get my presentation slide started over here. Let's see, you're able to give me access. Cool. Should work. It also is really interesting. Most people, kind of going back to what you were saying earlier, Megan, the like for like, it's interesting how there's different types of property that someone could buy, including mineral rights into oil and gas. It's just strange, there's all different kinds of unique ways to get into those types of things. So there we go. All right, we're set. Cool. All right. So let's see if I can do full screen. We'll just do it this way. So everybody, my name is Skyler Stokes. I'm the founder and CEO of Aloha Wealth Partners. We are a boutique investment management firm, and we help clients through 1031 exchanges and all sorts of other off-market private equity and syndicated and direct real estate and private investment offerings. I've been in the business for over 15 years. And my goal starting the firm was really to try and help bridge the gap between what I guess everyday Main Street folks wanted and what Wall Street represented. So I was a lifeguard in Kauai at one point, and I've been going back and forth in the islands my whole life. So what I want to do is I wanted to marry that feeling, as I don't know if you guys have ever been to Hawaii, but stepping off the plane and then having that like fresh breeze of plumeria across your face and the salty sea air, it's like the best feeling ever. So I wanted that kind of feeling and that experience for my clients. That's the reason why we started Aloha. Before we get started though, one thing, any sort of investment.
I have to get away from you.
Oh, any sort of investment is going to involve some sort of risk, especially real estate, because the market is, not something that we can predict, and my crystal ball always is seemingly in the shop. So we can't anything that we talk about today, there's no guarantee that any strategy is going to be delivered. And there's also change of tax status. These sorts of investments are illiquid. So those are things to take into consideration. Let's talk about Delaware Statutory Trusts. So through the 1031 exchange, just like Megan was talking about, you can do a like-for-like exchange into any type of really real estate, as long as it's held for business or investment purposes. What's great is that when you get to the point where you're looking at an exchange, or you have a client that's going through an exchange, and let's just say they can't find an investment property because interest rates are through the roof and the numbers don't pencil out from a cash flow standpoint, it just gets really dicey for clients because they have to pay massive gains or potentially massive gains and tax once they sell the property and they can't find something. Inventory is low because everyone seemingly from all over the country decided that Southern California is the best place to live, which obviously it is. But it's really hard to find a property to exchange into that really pencils out. So there's a way that the IRA or that the investment community kind of came together and said, okay, for those folks who are needing to find something, what we can do is we can put together a real estate property and then put it in such a way in which it actually satisfies for a 1031 exchange. So in this case, it's called a Delaware Statutory Trust, or a DST. Basically what DSTs are is they're legal entities that hold real estate assets, and it can be any type of real estate asset, just like Megan was talking about. It could be raw land, it could be a multifamily kind of apartment complex, it could be commercial, it could be a parking lot, it could be whatever you wanted. And so basically in this case, what they do is they put these deals together, they put them in a trust, and then they fractionalize ownership of that trust so that investors can have a piece of that trust and thus satisfy their exchange requirements. It currently qualifies under like-kind exchange under ruling 2004-86, where the IRS gave it as its blessing and said, yes, for the moment, it looks good. But these types of investments, because they are Regulation D securities, which are off market and non-traded, they're considered, you have to be an accredited investor in order to be considered. So a minimum net worth of $1 million, excluding your primary residence, or you have to meet certain income thresholds, which is 200,000 if you're married, or 300,000 if you're married, or 200,000 if you're single over the past 2 years. So if you pass those kind of those check boxes, then you could consider, or you could be considered for this particular type of investment. So like we talked about, the owners of the trust have a fractionalized interest in this particular type of property. And any sort of income that's derived from the property, any appreciation that's derived from the property ends up getting passed to the investors, because that's the way that that has to work. Typically, there's 499 investors that can hold into a single DST. But DSTs don't necessarily have to be one property, they can be multiple properties. So it could be 2 or 3 multifamily assets around the country just packaged into one portfolio. So you get diversification into different markets and different assets, things like that. So one of the coolest things about this is we were talking about the 45-day exchange ID period, where as soon as you close escrow on your relinquished property, you have 45 days to identify new property. And like we were talking about, it can be really hard to find a property that satisfies kind of what you're looking for. And so in this case, because the properties are already in the trust and there's already an address on that trust, you can utilize that particular DST as a way to satisfy your exchange or your identification for new property. So let's take as an example, you sold a property for $1 million and you can't find something in the local market. Well, if you can't find something and it's day 43, you come to us and you say, Skyler, like we're in our 45th day, or you talk to Megan and Megan's like, you have 2 days left or 3 days left. You should talk to Skyler because he can help you with at least finding something and putting something on your ID paperwork as almost like an insurance policy, if you will. So in this case, they're easily identified for a 1031 exchange. Most of these properties aren't necessarily the kind of houses that you find on the corner of the street. These are world-class institutional grade real estate assets. So they're typically Class A multifamily complexes between 150 and 350 or 400 units in high growth, high density market areas. So Texas and Tennessee, income tax-free states, Atlanta, just places where, there's a lot of growth and activity from an economic standpoint. And most of these sponsors, they're called sponsors that put the deals together. They have this, crazy team of underwriters and analysts and acquisitions folks that say, okay, where's everybody moving to? Where's the net migration going to? And so they just do like all this, crazy stuff to identify if this is a good investment or not for investors. They have a fiduciary obligation to do what's in the best interest of the investor. So if that means, raising income or selling at a particular time because it's the right opportune moment for the property because there's huge appreciation potential or value there. That's something they're going to do. So you're getting institutional grade real estate with institutional grade management. Cantor Fitzgerald is a sponsor in the space. I don't know if you know who that is, but they're a 75-year-old investment bank. They have over $1 trillion of assets under management. They're huge. They're just a massive company. Blue Rock, just multi-billion-dollar companies. They are putting these deals together to help clients who are in exchanges to find solutions for just satisfying their capital gains deferral. The second thing, or the third thing is any sort of investment in these DSTs, it's all passive. So it's not like where if you're doing an exchange locally and you have to find a property and you're thinking about, well, I have to find somebody to help with the landscaping. I've got to get like a roofer together. I got to get this together. Like it's all done for you. It's all passive. So effectively you just become a member of the check of the month club, and any sort of income that's produced from the properties ends up getting passed through to you as the investor. And again, any sort of appreciation as well. The sponsor has a duty to ensure that they're maximizing the value of that property. So again, like the appreciation potential ends up getting passed through you as well. There's a little disposition fee at the end the sponsor takes to sell the property, but other than that, it all goes to you. Here's the other really cool thing too, is let's talk about the interest rate environment and the debt, kind of where we're at right now. If you have a property that you're trying to find that for a replacement and you need to find a loan to basically satisfy the purchase price of the new property after the relinquished property, it's kind of hard to find, right? You have to find a lender that will give you, let's just say 60% loan to value. It's going to be hard to find in this market, and it's really not going to pencil out. So what's cool is the DSTs, they already have the loan attached onto the property and into the deal, and it's non-recourse, and you assume that new debt. So as an example, let's go back and say, if you have a $1 million property and $500,000 of it is equity and $500,000 of it is debt. If you sell, you have to replace the full $1 million of property, right? Well, it's gonna be hard to find a value of $1 million and have a loan of 500,000 if it's not, and it's probably gonna be eating in your cash flow to where you're kind of backwards. So in this case, you can identify a DST, and because the debt is already on the property, you don't have to go out and actually find that new loan. You don't have to sign for the loan. It's all wrapped into the deal. And then you assume that level of debt. So it basically means that it comes off of your credit score because you're not basically signing for anything, and it's non-recourse. So it makes it really, really easy from an exchange standpoint. If you're trying to find a replacement for debt, you can utilize a DST to do this. It's not just individual investors too. There's capital groups and institutions that utilize this technique, because again, it's really difficult to find property right now that pencil out and make sense. So there's some groups that are actually buying into deals that have 85% loan to value, satisfying some of their debt requirement, and then using the rest of the exchange proceeds to go and find something that actually does make sense for them. So it's a technique that you can use for high levered deals, or if you are trying to find something and to replace the debt, you can use it just to like a 30% or a 40% loan to value. You can do that too. There's also DSTs with no debt. So if you feel like you don't want to have that responsibility, you just feel more comfortable, sleep better at night knowing that you have a property that doesn't have debt on it. Those are also options in the DST world as well. There's about probably 80 different deals today in the market that are DSTs, again, ranging from multifamily to raw land to oil and gas mineral rights to all sorts of different things. So you can pick and choose from a multitude of a menu, if you will, which is pretty cool. The other thing too is these deals aren't necessarily designed for, you know, $1 million purchases all in one kind of go. They have minimums of $100,000 typically. So in other words, you could really diversify your portfolio base. And let's say you sold a property for $1 million. Let's just say it's 50% loan to value. You could break that $500,000 of equity up into 5 different deals if you wanted to, right? So you could have different markets, you could have different asset classes, you could have different levels of debt, you could have all sorts of cool things. So it just makes it really, it's a cool way to get creative with finding new property and getting into something that you may not ever had the chance to, but now you can, because these DSTs have the opportunity to get you in at 100,000 versus 10 million. So it's a really cool kind of feature. Our job is to go through the different all the DST market. There's about 40, 50 different sponsors in the space all at one time. And so our job is to do our due diligence and underwrite the properties, the companies, how long they've been in business, the track record, the fees, and then go through the investment strategies to make sure that the process that we're implementing makes sense and lines up with what the investor is looking for. So again, because of the flexibility and the nature of the opportunities that you can get into, our job is to make recommendations, and then client's job is to make the decisions. Of course, we've been doing this for a while, so we understand, we have a ton of different relationships in the space, and we know which companies, are better aligned with investors and others, their fees and things like that. So that's our job. So everyone's like, okay, this is great. It sounds insane. DSTs are my thing. I think it's a perfect solution for where we're at right now. And then I say, great, hold on, time out, flag on the play. There's a couple things you should know about. Usually, because DSTs are, once the property is purchased and the investors get in the deal, it's closed, which means that there's no secondary market for those shares or interests in that DST. So in other words, there's no secondary market for you to sell your particular interest in the DST. So we consider that illiquid, right? You can't necessarily call the sponsor and say, hey, Capital Square, I want my $500,000 back. It's been fun, but I found something down the street that I want to buy. They say, sorry, Tim or Susan or something. We can't do that because the property's kind of running right now. You have to wait with everybody else until we sell it. So there's no liquidity in the DSTs. The second thing is it's passive ownership, right? So everything, you basically pass off all of your responsibility, all of the debt service, like all that stuff is taken care of through the sponsor, which means that you aren't personally required to, or you have no responsibility on managing the asset itself. Some people actually like doing it, which is totally cool. Like let's just say, you actually like going in and painting walls and changing doors and handles and things like that. That's totally cool. That's something that DSCs don't allow you to do. So the passive ownership is something that people just occasionally, they like the hands-on feel of taking their own property by their hands. The third thing is the holding periods. Generally speaking, I like to say that DSTs have a runway of between 5 to 7 years. Most DSTs have a 10-year life cycle where the debt on the property ends after 10 years. And there's rules that we'll go through in a second that DSTs can't cross. There's lines that DSTs can't cross, otherwise they would be triggered and then there'd be capital gains for investors. So typically the hold period for DSTs is roughly 5 to 7 years. That doesn't mean they're going to hold it for 5 to 7 years, but it's just a conservative way to approach it. I've seen some that have sold within 2 years. I've seen some that have sold within 9 years. So it's a average, right? Just something to take into consideration. So again, rules and restrictions are very important because DSTs have to, in order for the IRS to continue to make sure that these are good investments for investors, they can't do certain things. And namely, they can't renegotiate new debt on the property. So there's no new debt, new financing. They can't obtain new capital once everything is raised. They can't call you and say, Tim and Susan, roof needs some repair, so we're going to need 20 grand or something. They can't do that. It's not allowed. You can't enter into new leases. You can't make huge structural or major improvements to the property. You can do like minor, new lick of paint or just some minor cosmetic things, but you can't move walls, you can't build stuff, you can't erect new construction. And then anything that you can't take money and you can't invest it in anything other than short-term securities. So it's basically designed to minimize the risk for the investor, because if these companies were allowed to do all these different things, then it could cause a huge problem for investors in the long run, and they can't do that because they're under the obligation to do what's in the best interest of them. And it's just, there's too many kind of factors if there's more than 2 or 3 people in the deal. So let's talk about a case study. Bill and Shelley, they're real estate owners. They've owned real estate for quite a while. They're in the mid 70s. Bill was he was a broker at Remax for a long time. They have 3 girls and they're in different states. And Bill and Shelley have a pretty good portfolio of real estate. They're at the stage now where they're like, you know what? Bill's a really hands-on guy. He loves doing stuff. He loves, I was talking to him today. He's like, trying to figure out what he's going to put on the deck of one of his properties, and, whether it's going to be, what's it called? He's just trying to figure out some projects on some of his properties. But then his wife, Shelley, is like, I don't know if I want to do this anymore. I'm tired of this. I want to go have fun. Our girls in other states, I want to go visit them. I want to do all this other stuff. So they're like, well, what do we do? So they're exploring DSTs as a way to exit out of the management of their properties, and then get into something where they're hoping to just, again, be on that membership of the check of the month club. So he bought a 5-unit building in 2002 for $600,000. Again, he's a very hands-on guy, did a ton of work to the property, kept value up, brought the rents up. And so he's thinking he's probably going to get 2.2 for it. He has about $500,000 of debt. So he has to replace a total purchase price of $2.2 million. But he only has, 1.6, let's say, after closing costs and everything else. So right now he's like, should I pay the tax? I'll probably pay $400,000 of tax because of depreciation recapture, net investment income tax, capital gains tax, both federally and state. So does it make sense to do that? Should I exchange and find something else that I don't have to, worry about the tax, or maybe a little bit of both? So in this case, what we did is we kind of built a sample portfolio for him. And we'll go through each of these deals very briefly. And if you have more questions on it, we can talk about it after. But basically, we were able to get him access into, tons of different markets. So 4 different markets with a total of, 3,000 units, basically 3,176 units. This asset's in Phoenix. He's taken on non-recourse debt, so it's a 48% loan to value. So his purchase price is $770,000. So all total, 4 different properties in 4 different states, 4 different states. Just super diversified portfolio. He's getting some self-storage in here, which he wanted. He wanted to get access to some self-storage, so he got into that. So anyway, long story short is we're replacing his total purchase price of 2.2 with 1.6 million of debt or of equity, and he doesn't have to, again, get any sort of loan. It's all kind of done, wrapped up in the deal for him. So our job, again, is to go through, like, here's kind of the situation. Here's what we think might make sense for you. Do we need to go back to the drawing board? But the long story short is, again, diversification, 4 different sponsors, 2 different asset classes. Here's some sponsor profiles. I can send this to you. You can read it. But again, 4 different states. And so it's a good way, again, to diversify your portfolio into different markets. Here's some other kind of things about the properties themselves too. This is a 2022 vintage. This property has no debt on it. It's in Charlotte, North Carolina. So it's a really hot market. It's growing. These properties, it's a 3 different property portfolio in Arizona and Florida of self-storage assets. They're climate controlled properties. Here's another asset in Phoenix. This is a 2023 construction. This deal's closed, but it's a really interesting deal. The Taiwan Semiconductor Manufacturing Company is moving a lot of their workers from Taiwan to the United States to work through the CHIPS Act, which was passed by President Biden in 2020, was it 21? And basically, if they're trying to reshore some of the semiconductor and manufacturing chips for computers. So this deal has a 3-year master lease that the Taiwan Semiconductor Manufacturing Company guarantees. They have a 6.5% annual rental increase in the property every year, and it's 100% leased out to that company and their workers. So again, it's all institutional grade stuff, right? These are things that you typically won't get access to unless you kind of have this, the DSTs in your back pocket, if you will. Here's another deal in Colorado. This is actually just down the street from a property that Blackstone just bought, and they're renovating. So the idea is this property is probably going to grow in appreciation quite quickly. So again, multifamily is a hot asset class. We could talk about that, after this. But again, final thoughts and remarks are, it's an illustration that we can go through for different clients, and we can kind of help explain why and the do's and don'ts, things like that. But yeah, that's pretty much the DSTs in a nutshell. And we're open to any questions. And thanks, Megan, for the opportunity to talk to everybody.
Yeah, thanks, Skyler. That was incredible. And I appreciate how you included examples of the different properties, because I think everyone can really use just a visual. And they were all different. So I appreciate that. Yep. So yeah, let's open it up. If anyone has any questions, you can unmute yourself, and we're here until all the questions are answered.
Yeah.
Anybody?
Yeah. I have questions.
Sure, go ahead.
Hi, this is Jan Bannister from Compass. I know there's been a lot of chatter because of our interest rate environment that a lot of commercial loans are coming due and everybody's facing higher numbers. How are you positioned with that, with these properties?
Great question. Typically, the way that these DSTs are constructed is they're usually 10-year interest-only debt. So it provides more cash flow to the investor during the life of the hold. There are some deals that have 2 years of interest-only debt and then amortizing debt or amortizing loan after that. But generally speaking, you're looking at 10-year IO debt, and it's usually done with, I guess, a much better price than if you were to get, or better loan terms than if you were to go get things yourself. As an example, if we were to go back to that one deal in Phoenix, where the Taiwan Semiconductor Manufacturing Company was in, that's a 5.9% 10-year industry-only loan that was acquired in August, so just a couple months ago. So these institutions, they get better pricing from Fannie and Freddie than if you were to get at your local lender. So, but again, each deal is different. It just depends on what the client is most comfortable with. What I typically see is better loan terms than someone who gets into something themselves.
Right. So what about, you mentioned with the example, which I really appreciated because I did have that in my notes, that we needed an example. The situation, the fellow from Remax, the one example, that it sounded like he had a little input as far as the mix where he got storage. Mm-hmm. So earlier on in the presentation, you're saying that it's hands off, you don't get to be involved. Mm-hmm. So is there something that a client does to say, okay, this is what I'm comfortable with. Can you put me in this kind of mix? Kind of like a stock market investment. I went, or not stock market, but, a financial advisor. I went X amount in bonds, X amount in stock for the diversification, right?
Yeah, absolutely. Yeah. My job is to show all the different deals that are in the market. And any client would tell me, I've always wanted to try my hand at, senior housing. And I'd say, okay, is there any particular market that you're looking at, or what's kind of like the cash flow you're looking for? What do you feel comfortable with? And then through all the different deals that are in the market, which I have access to every one of them, I'd say, here are what your options are. Here's the ones that I think are in your best interest because of X, Y, Z. But of course, it's up to you to make that decision. anybody can choose any different type of DST as long as it fits their parameters. Some deals do have more debt than others, so it can be a little limiting if you're looking for something with, again, 60% loan to value. You're not going to get it in today's market unless you do one of those, higher levered deals. Yeah, generally it's for those folks who want to take their foot off the gas and their hands off the wheel and have somebody else drive for them, just like Bill. This could be a great way to do it. And again, you can diversify into any type of real estate asset class that you wanted.
Right. Thank you. Also, looking at some of these people, good example, they don't want to be hands-on with their properties they're holding as they age. So there you go. They have the property. I don't know how their title might be if they're in a trust or whether you have limitations and how the title can be held. But I know Megan mentioned as far as the title situation and what could trigger a problem with the 1031 if you change title. So let's say you're, I don't know what the person's called that's invested in this stuff, the name, but anyway, that they die.
Mm-hmm.
And so what happens to, obviously it depends on their, if it's a trust and how that's structured, how does that impact any of this? I mean, obviously it's not a liquid asset. So what happens?
Great question. Typically what happens is when someone passes away, you get that step up in basis, which is the reason why I think most real estate investors like real estate and why their family likes real estate. In that case, they get the step up in basis. If this is an illiquid investment, which it typically is, I personally think that from an estate planning perspective, it makes it so much more advantageous because let's just say, the kids are, one is very frugal and is smart with money, while the other one is like a total, spendthrift or just spends everything. In this case, let's just say it's a trust, and the beneficiaries of the trust are, a brother and a sister.
Mm.
Sister is the smarter one, right? I have three young girls, and I can tell you that they're definitely going to be the smartest in the family. And then the brother is, he just loves spending tons of money, and he's just, kind of he does whatever he wants. In this case, the DSTs, because they're liquid, in my opinion, it's good because it allows for the family to hold the properties while everything kind of just gets, everybody can kind of step back a little bit while, they're kind of working through the trust and the estate. So they're not necessarily like, okay, brother, you're gonna get, $500,000 of this asset, and you're probably gonna sell it immediately and then go to Vegas and go, blow it on black. You know what I mean? Like, in this case, like he has to hold it for a little bit, which can be advantageous because it helps kind of smooth out that transition, and it keeps the assets in the family at least for a little bit longer. Typically, when someone inherits money within the first 2 to 3 years, 90% of that money is gone. So this kind of helps, slow that pace a little bit for those folks who, again, may not know how to spend that money, at least for, a year or two. Does that make sense?
Sure.
Yeah. But they do get the step in basis. They do get the step in basis.
Oh, good. Okay. Thank you.
Yes. You're muted, Megan. Oh, yeah.
Thank you. Patrick Gilly's raising his hand, so I just wanted to see if I could unmute him.
Got it.
Has to unmute. Whoops, wrong person. Why is my phone? Patrick, where'd you go? Patrick, if you can unmute yourself.
Okay, good afternoon. Can you hear me?
We gotcha.
You guys are fabulous. I greatly appreciate this information. I just stumbled upon 1031 exchanges myself, so it's a high interest area for me. You stated earlier that there's an actual possibility of getting into mineral rights in regards to a 1031, or is that actually the DST that has that? And if at all possible, could you elaborate?
Yeah, I mean, the oil and mineral rights is separate from the DST, so it's a matter of working with another specialist who, just like Skyler specializes in DSTs, you would work with another person that specializes in buying into the oil and mineral rights.
Well, actually, we
You
do have we do have a DST that is mineral rights, but it's cash only. There's no debt on it. So usually when you get into these mineral rights deals, generally speaking, they're longer term. They're much longer term holds. I personally, there's still a lot of things that I have to look into on the mineral rights side of things, because most clients don't really feel like they want to, put in $500,000 into mineral rights right away. So there's certain sponsors that actually do these particular types of investments for DSTs, and I'm still in the process of going through and doing my due diligence on them, but they are available in the DST space.
Very good, because I have family interests in Oklahoma and Texas, along that rock and shale area. So it becomes like something that we have to consider for our elders within our family, and basically just how to pass on the wealth that they built up over that time. It's just a very exciting area, and I thank you both for bringing that to the table.
Absolutely. Glad you found it interesting. It's phenomenal. Like, it's crazy. Like, I've heard, and Megan, correct me if I'm wrong, but isn't like, if on, let's just say like Catalina or Santa Cruz or something like that, there's moorings out there. Are those are separate property, right? You could buy and sell those moorings, or is that true?
I believe so, but it's like, for me, I've done so far and few between that I really wouldn't call myself an expert in that particular specific type of asset. So I don't really know enough about it to make it. I haven't done an exchange with it, to be honest with you. So
it's just so unique. There's so many different things that you can do that people don't know about, like air rights. You could do air rights, like those are things that I know. I've never seen that ever, but I just know that someone has said it one time, and I was just like, I didn't even know that was even possible. You can own the air. Like, how does that work? You know what I mean? So, any other questions?
You may have mentioned this early on. What does the acronym DST stand for again?
Delaware Statutory Trust. Delaware Statutory Trust, DST. There's two different types of DSTs. One is a deferred sales trust, and one is a Delaware Statutory Trust. A deferred sales trust is typically something like if you had a business that you sold, and instead of taking the capital gain all at once, there's a way, and although it's like kind of under IRS scrutiny right now, and especially state of California too, but the deferred sales trust allows you to basically break up some of that gain over the course of 10 years, maybe 15 years. And the Delaware Statutory Trust is, again, just for real estate, just for this particular purpose. Yeah.
Thanks again.
Yep. Looks like Patrick has another question.
I don't know if he can unmute himself. Let's see. Ask to unmute.
You can unmute your, there you go.
Can you hear me now?
Yep.
Okay, pardon me, I'm out in the field, so it's kind of a hit or miss at this point. Since you've been great answering questions, I thought I would possibly give you a little insight in regards to air rights. It's big in New York and California. You have sight lines where people are buying for the view, i.e. penthouses, Beverly Hills overlooks.
Oh.
When a property is lower, let's say you're on the top of a hill and there's a property lower on the hill than yours, they can't build up to obscure your viewpoint, or there's restrictions. So that's part of what they mean by like air rights.
Interesting.
Yeah, it affects a lot of regulations, especially here in California, definitely in Southern California. Everybody wants sight lines, everybody wants views, and you don't want to pay 2.5 on your first Beverly Hills apartment or penthouse and then have someone else pay $5 million, double the size of your building, put it in front of yours, and now you can't see anything.
Right.
They put those types of things. They put those types of things in there, and actually, you can sell those rights also up to a certain point. So
Yes. Yes.
that's pretty much everything. Thank you.
Interesting.
Thank you. Appreciate that.
So Betty asked, does that bypass capital gains?
Yeah, Betty's speaker isn't working. So she's trying to, I think, figure out, you know, if you're converting the property from a primary residence to the rental, like basically, are you giving up the exclusion? You know, you have your primary residence exclusion. If you're selling it as a single person, you can defer up to $250,000 of the gain, or if you're married, up to $500,000. But that changes once you convert it into a primary residence. Into a rental. So, you know, then if you decide, now let's just say you have a primary residence and you decide, I'm going to rent it out. I'm going to get a different primary residence, but I'm going to rent out the one that I had as my primary residence and consider that now a rental property. That now falls under the 1031 tax deferred, that section 1031. So then if you wanted to sell that property and defer the gain on that, you have to follow the guidelines now within the 1031 exchange parameters, which means that now you need to make sure that you've held on to that property and reported it as an investment property for tax purposes, which means that now you want to make sure that you've held on to it for at least a year or 2 years before you either exchange it into another property. If you sell it, then you're going to pay the tax, but you can then convert it back to a primary residence. So you can kind of keep going back and forth, just depending on, life circumstances. So it really comes into play if you're selling the property. Are you selling it as a primary residence or are you selling it as a rental? So with the primary residence, you want to make sure if you're selling it as a primary residence, if you've converted it back, that you've lived in the property and used it as a primary residence for 2 of the last 5 years. So if you're doing this back and forth, that you want to make sure that you're following either one of those guidelines in order to get the tax deferral. I hope that answers your question, Betty, but I think that's what you're getting at. Anybody else? No other questions, I don't think.
All right.
So I appreciate everybody. Skyler, I absolutely appreciate that you came on and gave us your absolute wealth of knowledge. It was incredible, and I appreciate that. And everybody will be receiving a recording of this. So if you're a realtor and you have investor clients, you can for sure share this recording with them. And so I'll be getting that out in the next day or 2 to everybody, but I appreciate everyone for attending. It means a lot. So
thank you.
all right. Thanks, everybody.
Okay.
All right.
Bye.